Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. With us today, we have a very special guest, Cooper Drenner. Cooper, welcome to the podcast.
Thanks, Whitney, for having me.
Yeah. Before we dive into the Merriman, a development deal, multifamily deal, 300 units in San Marcos, Texas, tell us a little bit about yourself, your background, and how you got into multifamily investing.
I appreciate it. Like you said, live in Austin, Texas. I'm actually born and raised in Austin, went to UT. And in Austin, they call us unicorns because so many people have moved here at some point. And if you've been here 4 months, you more or less are considered local at that stage. So this is the only home I've ever had. And my partner, Andrew, and I are both, again, born and raised Austinites, which is pretty unique. We own Wildhorn Capital together. Wildhorn is a small boutique multifamily operating firm based in Central Texas. All of our assets and focus is in Central Texas. We're really, again, we got into multifamily, and I'm going to be the first to tell you, we're a little bit of the kids that were born on third base and can pretend we hit a triple. Obviously, we love population growth and job growth and think those are the two most important transactions that you should be paying, or the metrics you should be paying attention to in multifamily investing. And so we've always loved that space because Austin has been, and Central Texas has been, the most prolific creator of jobs on a percentage basis over the last 16 years. But we're the first to tell you that, again, being born and raised here, are fortunate that our home has also been one of the most dynamic multifamily markets in the country.
Awesome. And we were talking before the show, we're both from Texas.
Absolutely.
I just told everybody. There you go.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Well, let's dive into the Merriman 300 units, San Marcos, Texas. Now, this isn't a more traditional deal where you found it, buy a building, do a value add or anything like that. This is more of a development deal. So tell me how you came across the land and the idea to start this development.
Well, I appreciate it. Again, for most that have either invested with us, and Whitney, we're fortunate as a partner with us on a deal, but Wildhorn has traditionally been a value add to, we own kind of traditionally value add to brand new assets, buying existing built assets and trying to operate them and create value. That has always been our traditional business plan. we have always stayed focused in Central Texas and really made the decision a couple of years ago that we'd rather be more 6 miles deep and 6 feet wide, meaning we'd rather be up and down the multifamily spectrum in Central Texas than be chasing sort of 80s assets across the country. And a lot of that is because we're really hands-on operators. We believe operations is hand-to-hand combat, that you need to be in your assets weekly and sometimes every other week or monthly, but you need to be in your assets, spending time with your people. And so some of that is the reason we ended up in development. And our partner on the deal, and truly, Winnie, it really wasn't our deal. We were brought in by a great group called Longview Equity. And again, I think a core thing your listeners probably hear a lot on different podcasts, it's about relationships. And I've known both key principals a long time, but one of the key principles I've had in almost a 20-year plus professional relationship. We were just spending time together, catching up, talking about what we're working on. And they're developers and we're operators. And they looked up and said, hey, we've got this transaction. We think of something that makes sense. They bought a movie theater that went out of business in San Marcos, Texas, at some point during the pandemic when movie theaters were obviously under the gun. The other thing for our listeners from Texas, San Marcos is the biggest major city, really halfway in between Austin and San Antonio. It's been one of the fastest growing cities in the country. San Marcos in itself really stands alone, kind of like a Plano to Dallas and some of these other submarkets, that it's also the home of Texas State University. It's got a lot of interesting economic drivers. And so they had a deal in San Marcos they thought it made sense. They were developing a multifamily deal for the first time. And I'm sure this has come up with recent podcasts, but the market's pretty interesting right now. And traditional development deals don't tend to make a lot of sense right now because what you're looking at is the way traditional construction debt is structured. It tends to be IO or interest only with a big balloon payment after 3 years. And in an inflationary environment where costs are running, and frankly, you don't know what liquidity, you don't know what rates are going to look like when your debt sort of balloons, a lot of people's development deals either don't make sense because of cost or the risk profile is a little too much with all the uncertainty that's down the road. And our partners here had some pretty unique debt opportunity through a relationship bank in East Texas where we were looking at a construction loan that was more structured like a 7-year fixed rate loan. And they really liked the idea of developing and holding. And that's, again, touches on something at Wildhorn that we think is really, really interesting. This idea of we purchased 3 deals that were in lease up because the mentality and the way you would lease up a product, if you were just trying to get it to 80% occupied and sell it, is incredibly different than the ways you would lease up a project if you were trying to actually keep it for at least 1 more year. They came to us as we started talking and said, hey, we recognize we want to go, our debt's going to allow us to not only build this, but lease it and hold it. We love the long-term location. We love the growth in San Marcos, but we know we're not operators. What would it look like if you came in as our partner here, help us make some smart decisions on the construction side, but ultimately that's their expertise. And then as lease up operates, we're going to now be the operators. And so it's rather than a build it, lease it, sell it, our business plan here is more build it. And then we actually don't have to refinance it. And then we can hold it and really live into it and cash in on the growth that we're not only seeing in San Marcos, but the flexibility that our debt allows us to have.
Interesting. And I want to get into how you structure that partnership here in a minute, but let's get into kind of the nuts and the bolts of old movie theater. Are there some caveats that we should be aware of? Is there like rezoning when you take an old movie theater and you say you're going to tear it down and make it residential? Are there environmentals in place? Like what goes into repurposing that land?
Great question. So what is valuable about an old movie theater? In Central Texas, we call it impervious cover. And this is where, as you know, Whitney, Central Texas politics about land use are different than Houston, Dallas, other parts of the country. A lot of it's because there's environmental reasons. San Marcos has a lot of water surrounding it. So water quality is a big, big thing in developing in Central Texas. So picturing as a listener, the movie theaters have what? Big parking lots. And so an actual constructed movie theater already has a massive parking structure. And so you've already got concrete on dirt. And ultimately, a lot of times what you're fighting about around land use is about height and impervious cover, concrete on. And the one thing that a movie theater has in spades is it's usually a pretty big structure and it's usually a pretty highly developed concrete pad. So a lot of the movement from there to housing is not politically a struggle there because we're not talking about putting more concrete on the ground. we're actually going to live inside the existing footprint. The other thing is obviously movie theaters. Even coming out of COVID, those trends have changed. And I'm someone that still loves going to the movies. But in a time where affordability is a big conversation, supply and demand tells you that if you're struggling with affordability and growth, and luckily, I'm never going to say struggling for growth in Central Texas is a bad thing, where it's a blessing to have job growth the way we've had, to have population growth. It's what feeds our assets. San Marcos is not immune to that. So putting more units on the ground, especially garden style units, is not a bad thing. It makes the city more affordable. So to your question, Whitney, there was a uniqueness to it. And I'll give all the credit there to our partner. They're the ones that identified this. San Marcos, again, I talked about, has been a place that also, you see this around the country. Some of these were traditionally smaller cities that have experienced 10 years of rapid growth. And they're struggling with deciding what they want to be, how they want to grow. We're not small towns anymore. Our school districts are having a hard time catching up. Infrastructurally, we're trying to catch up. The good news is San Marcos has already made those decisions and built the infrastructure to handle it. So San Marcos has traditionally been a much more reasonable place. And for that reason, they've also been really strategic in the ways they've grown their jobs and population as well.
Well, that's awesome. And thank you for all those details on the market. So I'm really curious, when your partner, I know they're largely the ones that did the construction piece, as they're looking at this concrete pad, essentially, and looking to repurpose it, how do they even go about that? Did they excavate everything and then like re-pour everything? Was there any environmentals that had to be done? Like, how did they due diligence like to make sure that this particular location would support the 300 unit building and that there wasn't any issues with the land?
So I'll take it in two phases. There's the underwriting about why is this the right thing to build? And then there's the conversation around, hey, is this a sound place to build it, right? And so
I think that's amazing. Yes, that's what I'm trying to get at.
The underwriting, what's good is San Marcos has actually quite a bit. It's, again, large student population. And so student population and student housing assets are incredibly different than traditional multi. And probably something I have not done and may never do in my career is take a conventional asset and try and turn it into a student asset, or take a student asset and try and turn it into a conventional asset.
Student housing development?
No, this is a conventional asset.
Okay.
But a lot of San Marcos asset class is kind of mixed. And that doesn't mean it can't be successfully done. But student housing lease up strategy, you have to lease it all up in the summer. And if you don't get full, you don't have a consistent leasing cycle throughout the school year. So it's a little bit of, I know what I don't know, and I know I'm not an expert in that space. And so what we saw is San Marcos actually, or what our partner saw, but also us when we decided to be a part of it, is San Marcos doesn't have a lot of new traditional multi, that a lot of assets are sort of conventional assets that students have crept into, or sort of someone's tried to blend between the both. But we've also seen over the last 3 years, incredible amount of rent growth with very little supply. And so when you see population growth, job growth, and really good absorption, but very little new product coming online, those are easy and obvious metrics. But ultimately, if someone's trying to make it seem like it's that much more complicated than that, Whitney, I think they're somewhat lying to themselves or trying to be self-important. It should be that simple. I also think different types of construction, and I'm sure you talk about this, really yield different rents. And so one of the areas where you can get in trouble on new development is saying, all right, well, good, we need to build a 500 unit wrap style project, which traditionally that means we're going to get $2.25 per foot or $2.50 per foot rents. That works here. And if we get those rents, then the project makes sense. And really what they're always talking about is return on cost, right? And San Marcos has traditionally, and still is, a submarket that desires garden style product. And so one of the areas where I think you need to be disciplined is making sure what you're building there actually is in demand. And the types of jobs that have moved to San Marcos and the types of people that are renting there are people that are more demanding a rent structure for garden product much more than wrap. And so we were fortunate there that when you were underwriting the rents that are being currently achieved, they underwrite and make sense for building new construction. But you do see people get into some trouble thinking, we've never been, Whitney, somebody that says, all right, we're going to underwrite, and in order for this deal to make sense, we now have to set a new high watermark for a submarket. That doesn't mean that other people aren't justified in doing that. That's just never been what we've sort of staked our name on. Is I always want to say, what if I get middle market rents? If my deal still pencils when I get middle market rents, then if we get top of the market rich, which I think we should, this thing's a home run. But our base case is never going to be in the market leader in rent. And then to the second part of your question, what do you study? I grew up and still am a land use attorney's son. So my father is a land use attorney in Central Texas. So I've always sort of lived and breathed zoning and how I think about even new acquisitions. You obviously always are going to come in and do your soil studies, right? Anytime you're looking at a deal, you're trying to understand, is the old adage, has there been an old dry cleaner on there? Are you downstream from a gas station? Just trying to make your soils healthy. And just like anything, no matter what's been there before, if you're tearing it down and going, you need to make sure you do soil studies on it regardless. But you also recognize that just because there was a movie theater there, what was there before the movie theater? Was it greenfield land? Was there something that they tore down to build a movie theater? All those things. And every property has a history. And sometimes it's not always going to be perfectly clean, but you want to get a very clear picture. In this case, it was a pretty dang clean site. The movie theater was only under 5 years old. It was more of a COVID casualty. And so we were really fortunate that we stepped into an environmental situation that was already sort of solid and blowed, and we knew what we were dealing with.
So we've got 300 garden style units being built on an old movie center site. As far as all the studies say, it's a good, clean site to build. What was the purchase price for this project? And what kind of details can you give us, like between the cost of land, the cost of development, the total cost, like for all the units? And let's get into various timelines after this.
For sure. So I talked about this offline. Texas is a non-disclosure state. We're always going to be somewhat careful, but I can say they were able to get the land at a far under market value because we're buying an asset with really no value in the teeth of COVID. So they were able to see something there. A partner was very quickly. But traditionally these days, garden style land is somewhere between $2 to $10 a land foot. I mean, we were on the lower end of that scheme here because, again, your rents need to be somewhat around the $2 a square foot or under rents all in, all done to make those things make sense. Traditionally, at the height of the market, you were solving for trying to underwrite like a 5 3/4 yield on cost. As the market softened, which what I think is a real estate recession, those metrics need to more look to a 6 1/4 to a 6.5 yield on cost. Hey, we're getting more bang for our buck for doing this deal. We entered into a GMP contract with a builder, but I will tell you that going back, all the things you're trying to do in our world in these times where, I mean, we're at the 22, 23 year high for interest rates, the highest interest rates of my lifetime. I'm 38. So second highest of my lifetime. It's been the fastest we've ever seen interest rates run. So the real key metric here was our debt having longevity is a really important thing. But the other way you should de-risk your deal is you're now looking at more, instead of an 80% construction loan, what does it look like to do a 65% construction loan? What are the ways we can de-risk this asset? And something I say on almost every podcast to investors is the worst metric you can look at when you're thinking about an investment. Because Whitney knows her model. I know my model. I can make that IRR say anything. And if you don't really, no two models are the same. And I'll send you my Excel model, but it looks like gobbledygook to some people. But if you don't really know the metrics that are being put in there, that IRR is so predicated on when you exit it, at what price you exit it. And so one of the questions I'm always asking and thinking about is, what are the key metrics that show us that we're de-risking this? Some of those things are, we're building this for sub 250 a door. That's really important for us, right? That being able to deliver this at a place where you know we're delivering it below where deals are trading today. We're de-levering the asset, right? If you didn't take more than 70% of leverage over the last couple of years, you're probably in an okay spot. But that I think is really, really important in its own right. And then the ability to underwrite and not have a maturity in the next 3 years is really, really important on your debt. And we're the first to say, I mean, most asset managers are navigating some form of maturity expiration from the next 2 years. We're included in on that, but it's folly to step into a brand new deal, making a bet a year ago that the market would be better in 2 years because you had no reason to base that on that. You had no data to base that on, that better said.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFI InCon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Awesome. Okay. How does a deal like this get phased then? Because the deal's closed. And that's, one of, requirements for everybody that we talk to on the podcast, right? Is that we want to talk about deals that have been closed. And this deal is closed. You raise money on it, and we'll get into the capital stack and how you work with investors here in a minute. But how does something like that get phased out? What is the timeline? And then let's get into how you work with investors on this.
So development deals are a little different, right? Because you don't have immediate day one cash flow. And that's also true of acquisitions right now. I mean, Whitney and I were talking about this. The reason this is the first time we've gone over a year without a traditional acquisition, because right now you're being asked to buy into a scenario where you're not going to have cash flow over your primary term unless you're underwriting that the world is going to recover pretty dang quickly. And so at least in Central Texas, I can't speak for what other markets are pricing deals at, but at least in
real
Central
estate's
Texas.
very local.
Yeah, absolutely. So that being said, a development deal has a lot of timelines in terms of how you get your building permits. So you're really spending almost the first 3/4 of a year with your pre-dev work, finalizing your designs, getting the horizontal infrastructure in, right? Making sure all of your time, your water and electric is delivered. That is in many ways just as important or time consuming as the vertical. Everyone always thinks of the vertical. That's when we go under construction. That's not always the case. Also, jurisdictions, and Central Texas is not immune to this, really want to make sure it's not a short, meaningless process to get a site development permit to break ground. And so you can have your debt right. You can have all your bows tied. So we're finalizing the horizontal work, and we're close to getting our building permits where then we're vertical, which is what most people in their head sort of think of as being under construction. We were incredibly fortunate to close our debt when we did, because debt doesn't exist today. And again, the not having the proverbial gun to your temple on the debt is really meaningful right now, right? We are starting to see, Whitney, construction costs come in and flatten. That's traditionally been one in our industry, the areas where we've seen an inflationary environment hit: lumber, labor, rents for that matter. And I think that's some things we're always afraid to talk about. Is we're quick in our space to go, man, inflation's really hit construction, or inflation's really hit my labor market or my staffing, but it's also hit our rents. And so we have to be mindful of those things too. And so that's where we sit today. That's what the last almost year has looked like. And that's why traditional construction projects take 2 years. What is interesting though, is we start leasing the project up well before we deliver units.
Let's talk timelines.
Yeah, for sure.
Perspective. So when did you close? You said 6 to 8 months for the horizontal. Let's put some dates to that.
We closed in March.
Okay.
We think we'll probably have our site development permit here in the next 2 months. And then you're probably looking at about 18 months of traditional
And we're
construction.
recording in July. So that was closing in March. We're recording mid-July. That's that timeline. Okay.
That's the timeline. And we started our fundraise. We were a fourth of the equity on this transaction, and we can talk about the structure, but our raise was pretty dang easy. It was actually very interesting that what we always want to be cognizant of is showing investors that deals that feel of a time, right? This deal and this underwriting, if you looked at it 18 months prior, probably didn't look like it made much sense. And if you looked at it now, it would be interesting. It would still be relevant, but the metrics, the debt metrics, you would be like, when did that debt exist? And so
what was the debt structure? Because I know you've referred to that quite often.
So we had more or less a fixed rate loan, which is without a balloon payment. It's a 7-year fixed rate loan at 5.25%. And so construction debt, as an interesting metric, we're working on a construction deal right now on the B2R space is a very interesting space to us, and the build to rent space, and construction debt now is 8.25%, 8.5%. So that shows you in a very short time how far rents have moved, or how far metrics have moved. And so we have a longer term where we're not looking at some refinance event in year 2 to get out of our construction debt. We'll stay in this debt long term.
Okay. So 3 to 4 months to get the building permits. And then you said how long to do the horizontal work?
And it's truly more than 3 to 4 months, Whitney. So it's been 3 to 4 months since we closed. I think you're more looking at 6 to 8 months to get your building permit. And in that time, you're spending some pre-dev dollars on getting all the horizontal work done. The city only really is governing what happens when you go vertical. So you're getting the site prepped and ready to go do your major work. You obviously call all your capital. On development deals, there's kind of 2 different ways of doing it, but you're calling all your capital more or less up front, because once you're off, you're phasing these deals. And most garden deals are built either between 3 structures, or sometimes you have 10 structures, and your layout's different from asset to asset. And so as you're building, like let's say in this project, it's 5 buildings, you're not building all 5 buildings at once at the same time. You're phasing those. So you're more or less, as you're starting, as the foundation guys finish on this one, then you bring in your framing guys. Well, those foundation guys go to building 2. So you want to have your stuff built in waves. And so over the next 18 months, we'll build those 5 buildings in stages. And so building 5 is obviously your last building that you deliver, and your lease up works in much the same way. As soon as we start to get close to getting certificate of occupancies in building 1, we'll start our lease up process there. And where you really see that, Whitney, is actually in year 2. Year 2 is the sneaky part of lease up deals, because you traditionally lease them up again. And you're leasing them up, for instance, in a build, like we own a project that has 3 buildings. Well, all 3, you get your certificate of occupancy for all 120 residents on the same day. Well, that means all your leases roll more or less on the same day. And as you know very well, that's a shot to your system. And so you need to be really thoughtful on, even inside one building, how those leases are signed and when people move in, because really where you're going to feel that is on the whipsaw in year 2. And that's the goofy stuff as an operator that we're obsessed with and we think about. And why our partner brought us in here as an operator is, if you think you're going to hold this deal, those are the unintended consequences if your goal is not to just get to 80% leased and sell it.
All right. Well, thank you so much for that. So construction, so the horizontal takes, how long does the horizontal take? 6 months?
Usually about 6 months. And trying to get a building permit in your first 8 months. In Austin, just to give you a metric, it sometimes takes 18 months to get a building permit. So even Austin to San Marcos is very different.
Okay. And I'm just trying to get a set timeline for an investor. So you're in before you're got everything ready to go vertical, it sounds like.
In some cases.
And how long does building 1 take to construct?
Building to building, it's a little different. What I would be thinking of as an investor is most construction projects for garden multi, and multi in general, it's usually 2 to 2.5 years soup to nuts. It's 2 to 2.5 years soup to nuts. And midway through year 2 is when the property should start producing income. And so that's why so many construction deals sort of have a 3-year construction loan. Is if you miss your timeline and there's something happens, you go slow, that debt is not slowing down. And just a reality of it is that 2 to 2.5 years tends to be from beginning to end what it takes to deliver a garden deal. And things like pre-dev work and getting your building permit are why you can't really go that much faster in some ways.
Got it. Yeah. And thank you for indulging me on the timeline, because a lot of the people that are actually listening to this are operators that are trying to figure out in this market, how do I pivot? How do I put together a deal? But we do have a few investors that listen as well. But let's pivot to the debt, because you said the debt was very key. You already gave us a little bit of insights into that, is that it's 7 years, interest only, fixed rate. Is it a public debt or a private debt?
It's a bank. It's a private bank. And that's another thing that I think is really important. When you go back to when your markets slow down, relationships tend to matter the most. And so this is a banking relationship that is multi-decade between our partner and the bank. And again, this I can't underscore any for both operators and investors and aspiring operators is the world sort of tells you when things are going and blowing that everything's transactional. But push come to shove, when the world begins to slow down, your relationships are going to win the day. Whether that's, hey, we're up a creek, lender. I need help. I need leniency. I need an extension, even though I don't qualify for it. Because you're right. No one on this podcast, I guarantee no listener of this podcast had a year ago rates, what's happened at a rate environment. No one had it because you wouldn't have been able to do a deal if it was in your model. So I always am careful with investors and with other folks to never say, I know for sure what the world's going to do. We're making our best guess based on the data we have. But if I could correctly predict rates, I wouldn't need an investor's dollar and I should be a lot wealthier. And frankly, there's probably a lot of more efficient things I could be doing. So we're always just doing our best. But when the world deals you lemons, your relationships are what win the day. And we don't have the opportunity to be in this deal short of the relationship we had. And the debt was purely relationship driven. And frankly, what you also saw in this in time period was lenders were tearing up term sheets. If something took 30 days longer than it should, a lender technically could go, yeah, that doesn't apply anymore. Sorry, we rescind it. We rescind the term sheet. And it takes something for a lender to say, hey, we quoted you this. I know the world's moved. We're going to stand behind it. I can't say it's going to be there on the next one. It won't be, but we'll stand behind it on this one. We thought it was fair then. We think it's fair now. And that was very much the case on this one.
Excellent. So let's play a scenario with this debt that you have. Let's say like in 3 months after, or not 3 months, that would be amazing. You wave your magic wand. 3 years once construction's, finished. Do you have like a repayment penalty if rates have dropped and you wanted to refinance it? Do you have a lockout period? Is there anything like that on the debt?
Not really at all in this case. Because of that, yes, in the first year or two, undoubtedly. But once we get past year 3, there's nothing that's going to keep us from refinancing this deal. In much the same way, I know I've referenced going longer here, but one of the other things I've seen over the course is we have a business plan that can withstand bumps, that we can withstand trauma. But that doesn't mean if the market recovers quickly and we see another run up and rates decrease, that we won't sell this deal when we're 80% leased. Because as an operator, it's the number one thing we think about is you just need to do what's best for your individual investor. And there is seasons where that is selling quickly and taking a win and hanging a banner and delivering that IRR to investors. And sometimes that's going longer. But you're just doing the best thing you can. But you always want to be coming at it from the view of we're going to do what's best for our individual investor in this individual deal. And so we have the mind's eye to go long, but that's also going to be based on what the market's doing once we deliver and finish this asset.
Gotcha. Well, let's pivot and talk about the rate. So I think you painted a picture earlier whenever you put out this deal, your investors understood that the market had changed and that the cool thing about this deal was investing in the debt, actually. Let's talk about the actual returns that investors are expecting or looking at. Like, did you offer a pref? What were the splits? Did you have any IRR hurdles?
For sure. So we try and keep it pretty simple. Again, every deal is slightly different, but traditionally, if you've looked at a Wildhorn deal, we usually do a 7 pref with a 70-30 to investors above that. We try and keep a relatively high floor. Different deals in different environments sometimes have other hurdles. In this case, I don't believe we had any hurdles. It was the 7 over a 7 pref with a 70-30 to investors over that. We projected a mid to high teens return, stress testing a few different cases. We always try and show you an upside and a downside provision in our deck. And frankly, one area of criticism for us is we consistently hear that we're a little too dour in our underwriting. But I always want to underpromise, overdeliver. I mean, we've routinely never showed investors better than a low teens to mid to high teen. We've never showed a 20 plus IRR in our model or in our investor deck. And we've averaged returns at an average of 30 over the last 5 years. Some of that is pure luck and in a market that was moving. But some of that is, I would rather show you what I think worst case scenario is and stress tested and things I can control. And then we're going to celebrate in that upside together. But sometimes when people see an upside scenario on a page, that's what they're going to hold you accountable to. We've also been always a little longer in that case, Whitney, on what our hold period is. And I'm happy we're doing that today because deals that we thought were 5-year holds may end up being 5-year holds given what the market's doing. But when you show somebody a 3-year hold, in their head, they've expected their money back and then some in 3 years. And many people are going to be missing those most timelines given the market we're in. So that's how we underwrote it. That's how we show investors. That's our mentality, for better or worse. But the kind of running joke is if in the last 3 to 5 years, you've seen a 20 IRR in Austin, send me your book. I'll point to the thing in there that's out of market. They've either got a little asterisk in their book that shows a supplemental loan or a refinance. And again, there's nothing wrong with projecting or showing an investor what it looks like if you do that. I just think you need to be chest out, bold about it. So an investor understands going in the risks that they're undertaking by believing in that scenario.
Well, and also part of this, like, what did you show investors as far as fee? Did you guys take an acquisition fee, asset management fee, reposition fees?
We tried not overfee deals. So we always traditionally take an acquisition fee, but it was an under market acquisition fee in this case. There's a development fee that we don't eat in, our partner is a part of in this case. And again, we think that was under market, sub 2%. We always take an asset management fee, but that asset management fee doesn't start till leasing starts. And so from a leasing standpoint, the asset, we're not collecting a fee right now. We're working on the deal free, but it's not free. We're heavily invested personally in this deal. But we never want somebody to question. We don't have disposition fees traditionally in our deals. We don't have reposition fees. We don't have refinance fees in our deals. We try and sort of get what I always say in partnerships and not is people should get paid for the work they do. And we're going to get paid. But the biggest payday we ever receive is if we deliver the returns or better than we promised you. I want an investor to always look at us. So yes, we have an asset management fee of around 2%. What we try and do is think of that all in because you're paying a property manager as well. And we never want that to exceed 5%. We don't have an asset in our portfolio where it does. But the other thing I would tell investors is like, always ask what the raw dollars of that is, because sometimes you'll hear an investor go, well, I feel like a 2% asset management fee is outsized. It's a 188 unit project. So that's roughly comes out to about $4,000 a month. So is that your problem? The raw dollars tend to matter more. So sometimes you see someone take a 1% acquisition fee and you're like, well, that feels low. What's that in raw dollars? Because depending on the deal side, that could be quite a lot or not very much.
Absolutely. I've got 2 questions for you. I'm going to ask them both at the same time. So what about this deal did you find easy that you thought was going to be more difficult? And then what did you think was going to be more difficult that you actually found easy?
Anytime you step into a partnership, I answer the latter first. Anytime you step into a partnership, you never know. Most people tend to agree what happens when things are going great. The market's in some ways deteriorated more than when we had the deal under contract or when we closed on the deal for that matter, Whitney. So I've been so pleased with our partnership here. Andrew and I tend to be pretty free thinkers and sometimes challenge the status quo. Our partners here have been Longview Equity is an incredible investor and would suggest anybody following them. I mean, a really great group that has a great track record, but the character of the people is the stuff that I think sometimes people don't underwrite when they look at a partnership at any level. And the character of people we were stepping into here was as good as you could ever hope. And we've seen that translate and play itself out in really small ways that make this deal work really well. Because ultimately in any partnership, you want to be doing what you do really well. With Andrew and I at Wildhorn, we have very different skill sets. And on a day in, day out basis, we're really connected. But if we're both doing every job, it's not very efficient. And in this case, our partnership's been really healthy. And frankly, I didn't know what that would look like. It would be our first time stepping into a true partnership here. In terms of what has been...
Well, before we answer the last question, like, how did you guys structure the partnership? Somebody's doing construction, other person's doing the lease up.
Yeah, in this case, they're 3/4 of the money. So we split in some decision-making, but major decisions, it's their decisions. So again, that's knowing the character of the folks we're stepping into, having a 20+ year relationship. But then we found them to be incredibly fair. And what we always talked about was, if this is a partnership that only works for one deal, it probably is not worth it. But in much the same way, our Venn diagrams about what they do as developers and frankly, land use repositioners and what we do crosses, but not that much. And so what we hope is that in much the same way, Longview will be partners in Wildhorn deals. And so we structured a capital structure in a way that was where both sides felt like they were meaningful partners. And then in terms of fees, people are getting paid and will get paid for the work they have done. And again, your antenna should go up if everyone's so concerned about a fee and not about the performance of the deal. And so everything about the structure here was with a multi-deal lens, not just one deal in this time. And taking a longer view, I mean, that's part of why their company's named what it is long view, is taking a longer view of not just this deal, but the market and how we treat each other translates to all those other things.
Awesome. Well, and I didn't mean to interrupt you. So what did you find?
No, it's a great question, Whitney.
Yeah.
I would say raising in this environment, I was telling you, I probably never had a higher positive things said about a deal. We were raising $4 million, which is the smallest raise we've done in 5 years. I probably never had more positive conversations where someone's not challenging me about my underwriting metric, but a lot of investors were really worried about liquidity for themselves, stepping into what the next 6 months that we've lived through was going to look like. And they weren't wrong for being concerned in those things. I mean, everybody's probably in a deal or has a deal where there's been a capital call. And you could have done everything right in your underwriting, but when no one had their rate cap expiration costing over $1 million. And so what we saw was that investors were looking for deals, but they were recognizing and becoming more sober-minded that one, they probably weren't getting a lot of money back in the next 24 months, that they weren't going to be exiting deals with returns. And two, that all of us were maybe going to be asked to continue to invest in our assets to de-risk them.
No, I can 100% agree to that. So Cooper, thank you so much for sharing your knowledge and experience with us here today. If people want to find out more about you, how can they do so?
Absolutely. We're active on LinkedIn. I'm active on all the socials. Again, my name is Cooper Drenner. But more than anything, if you have interest in ever seeing the opportunities we have to invest in or setting up a call to get to know us, wildhorncap.com. Again, we're based in Austin, Texas. This is Austin and Central Texas is our home and where we're focused. And in much the same way, we want to know the people that are in our deals. And so we welcome the chance to get to know you. Easiest way to get us is through the website.
Awesome. Well, Cooper, again, thank you for your time today. And we look forward to hearing about future deals.
Thanks, Whitney. I appreciate you having me.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.